Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's head over to talk about what's happening at our good friends at Walmart. Again, a really good quarter. Some revenues beat earnings. Talking pretty. I think people really look at Walmart as kind of a read on the U.S. consumer, and that was kind of, I guess, a pretty good report there. Let's check on Jen Bartashus. She follows all the retailers for Bloomberg Intelligence. She is in Princeton, New Jersey, I'm guessing. Jen, what's your takeaway from our good friends in Bentonville?
Yeah, good morning, Paul. When I look at today's results, I think one of the striking things that is a takeaway that is beyond just the story of the higher income consumer, which everyone is focused on, is that the multiple year strategy that Walmart's been employing to change their business mix is really starting to yield results. And that's allowing them to grow operating income ahead of revenue. That's, driving profitability, and it's driving that long-term margin expansion that they think they can sustain. So to me, this is a great quarter. And yes, they do have a great read on the consumer, but it is also starting to show that all of those investments are really paying off in the way that they're evolving the company.
So Jen, I'm vowing to do a store walk this Saturday for the Walmart near me.
Right.
How do I do that? How would you do it? Like, what do I do?
Well, you drive there and then
I'm
you
going to
park
get
the
there.
car.
But there's a million aisles. These things are huge.
They are, what I would say, Paul, is wander around a little, but what I do when I go into stores is I find one of the people who are picking the online grocery orders or their online orders, and I follow them around. And that way I get a sense of what is it that people are actually buying, what are they putting in their basket, and how are employees actually effectively navigating that big store. So that would be one tip I'd have for you.
That's very cool.
I like that. I'm gonna do
Okay,
that.
you definitely should be doing
They're
that.
gonna be like, hey, there's this dude trailing
Yeah.
in security.
Aisle 7,
Yeah.
Get that guy. Jen, when we look at the areas of mix that you were mentioning that they sort of are changing their business mix, that huge part is e-commerce, right?
It is.
If their main competitor, though, is Walmart for e-commerce, how does that evolve?
Well, what Walmart's been doing is they've added a lot of sellers to their marketplace. It's unlocking ad revenue growth. It's unlocking the ability to charge for fulfillment services. Now, these are all things that sound very familiar because they're things that Amazon, for example, is very strong at. But that doesn't mean that it can't help Walmart evolve, and it can't help make Walmart a much stronger company in the long term. I think the advantage that Walmart has is because they have that strong store base, they can help keep some of their costs to fill digital orders down, which helps them with that overall profitability profile as well.
When you talk to investors about Walmart, again, it's stock hitting an all-time high here today. It ain't cheap. How do you talk to them about valuation? I got it like 26, 27 times on a PE basis. How do you talk to them about valuation?
To get to your question, Paul, it's really, when I'm talking to investors, it's, about where is the company headed, right? So I think one of the things that's admirable about the company, or that is really something they just do so well, is they keep their core operation tight. They're good at controlling costs, but they are not, they don't hesitate to invest in opportunity, but they also will walk away from things that don't pan out. So I think, you saw that with the announcement earlier this month about closing health clinics. At one point, they thought they might be able to, drive a big business out of that. Realistically, couldn't make money, closed it down. So I think that spirit of trial and error, the willingness to actually try to flex, but then know when to say, okay, this isn't what we wanted, is something that has become a strength of the company, and helps put it up as a company that justifies potentially a higher valuation versus some other strict retail peers that are really just focused on growing a retail business.
I think she's good. I think you can ask one more question.
Yeah.
I think I'm going to do it. What Amazon has, though, that Walmart doesn't, is AWS. That's where they're going to get their bulk of their margin. That's where they get all the juicy, sexy revenue. Walmart doesn't have that. So is that so how does it sort of ramp up other revenue streams that can yield that kind of growth and margin?
That's the question of the day, right? Because you don't actually want Walmart to be another Amazon. You want Walmart to be Walmart. And so I think that when you look at some of the areas that they're doing well, especially in some of the international markets where they're playing around with it in things like fintech, those are areas where I think that there's some great opportunity for the company without them having to try to be a cookie cutter of Amazon and have some have something like an AWS that is not natural to their current operations.
All right, Jen, thanks so much for joining us. I appreciate it. Jen Bartashus, she covers all the retail stuff for Bloomberg Intelligence, including Walmart, again, which had a really good quarter, stock up 6% here, all-time high. So good stuff for that. I think a good, little just kind of a bullet point there for if you're trying to get a sense, a beat on how the consumer's doing fairly well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. So here was the front page of the FT today when I logged in. Apparently, Starwood Real Estate Investment Trust, C-REIT, is one of the largest unlisted property funds, and it has drawn more than $1.3 billion of its $1.55 billion unsecured credit facility since the beginning of 2023. That sounds bad. That sounds like they're in a cash crunch kind of scenario, Paul. And as we keep hearing, commercial real estate is in a really tough spot, but yet I haven't seen a lot of shoes dropping.
I haven't either. I don't know how this is going to play out. Maybe our next guest will help us out with that. Rich Hill, Head of Real Estate Strategy and Research at Cohen Steers, joining us here in our Bloomberg Interactive Broker Studio. Why? Because we're here every day, and that's how we roll. Rich, I walk from Penn Station to here every day, all through Midtown Manhattan. Now, I know this is not the world. It's only Midtown Manhattan, but there's a lot of vacant real estate. People aren't coming back. I saw via Twitter yesterday a B of A report, Bank of America research report, that kind of showed vacancies. And it seems like they're calling this new normal, which is about 50% of commercial real estate properties, they're calling that the new normal, just because that's kind of what the data is showing. A, do you agree with that? And B, what does it mean for the owners and the lenders and all that kind of stuff, the whole ecosystem?
First of all, thanks for having me in this morning. It's good to see you guys. Look, I'll begin by saying people like to talk about commercial real estate as a big singular asset class. But in reality, it's actually 18 different subsectors under a big umbrella. And those 18 subsectors can behave very differently in very different market environments. So you're leading with New York City. Yeah. You're right. New York City office vacancies are high. Retail vacancies are high. Leading with maybe retail, that doesn't actually tell the whole story, because if you actually look at what's happening with retail real estate across the United States, it's actually on a really strong footing for two reasons. I think, you rewind 10 years ago, everyone was talking about the retail apocalypse. So no one really was building new retail properties over the past 10 to 15 years. So you had no new supply coming, and then COVID was a great Darwinistic event where it actually sort of right-sized all the retail properties that were maybe on the edges. Then you couple that with the fact that e-commerce companies realized that physical retail real estate can provide micro-fulfillment to their customers. The retail real estate market is actually on pretty strong footing, particularly open-air shopping centers, whether it be community centers, neighborhood centers, or even power centers.
That's a really interesting point. And you're right, we kind of lump it all in commercial real estate, we think office. So is that trouble spot office commercial real estate? And again, when is that shoe dropping?
Yeah. Look, it doesn't do any good to say anything other than the facts about office. Office is struggling nationwide. By the way, we probably built too much of it prior to COVID. Work from home dynamics have tipped that. Nationwide, office vacancies are at 20%, and they're increasing from here. And so there's a lot of ways you can unpack office, though. Just like I said, maybe the truth is somewhere in the middle. It's not as bad as everyone fears, and it's not as good as everyone fears. If you look at office, new clean and green office, even in New York City, is doing exceptionally well.
Like Hudson Yards is doing well, right? And that One Vanderbilt thing.
One Vanderbilt leased up to almost 100% during the middle of COVID. So Class B and C properties are properties that were built in the 1970s and 1980s with no CapEx put into it over decades and decades and decades. Look, I get it. No one wants to work there. So we're sort of in this weird time period where office is struggling. I want to be clear, office is only around 20% of the CRE market. It's only around 3% of the U.S. listed REIT market. But look, everyone loves a great Greek tragedy. I get it. Like it sells clicks, it sells papers. It is a really challenging asset class. And so I don't want to belabor that.
What's the lending environment like now for real estate investors? What are the banks doing? Where are the real estate investors sourcing their capital?
Yeah. So this is probably the single most important topic when we talk about commercial real estate. The reason being that commercial real estate is an inherently levered asset class. When people buy a commercial real estate property, they put debt on it. There's not very few properties that don't have debt on it. So it is a levered asset class. And so that's actually why valuations are being pressured so much. We think property valuations generically are down around 20%. Office valuations are probably down 35%. The reason they're down so much isn't necessarily because of fundamentals. Fundamentals ex-office are on pretty strong footing. It's because the right side of the balance sheet is repricing. Both financing costs higher and the availability of debt much lower than where it used to be. So look, lenders aren't lending as much as they used to. If you look at the Mortgage Bankers Association's senior loan, their loan origination index, it's close to the lowest level since we've been in 2014. I get it. A lot of people have loans on their balance sheet and they're working through those. But you made a really good point. Distress hasn't really come about yet. And I think there's a really important point, and I'll pause here for a second. Lenders and borrowers are in a pretty challenging position. So they're actually solving the prisoner's dilemma.
Meaning that a bank doesn't want to own an office space.
So a bank doesn't want to own it. They're not in the business of it. And guess what? The regulatory capital charges for owning a property on your balance sheet are actually higher than if you were just to modify the loan at, say, a 99% LTV.
LTV. Ooh, okay. Break it down for us.
Loan to value.
Okay. So what would that mean if you brought that down to 99% LTV? Yeah.
So let's assume 10 years ago you did a loan at a 50% LTV. So you had a property that was worth $10, and you put a loan on it was worth $5. So 50% LTV. Fast forward 10 years, the value of that property drops from 10 to 5, and you still have $5 of loan. That's 100% LTV. The regulators are actually incentivizing the banks to actually modify and extend loans. So some people might call it kicking the can down the road. I don't necessarily think it's kicking the can down the road. I just think borrowers and lenders are incentivized to figure out a way out of this environment. It's a pretty challenging environment for everyone right now, and so they are coming to a less bad situation, modifying and extending these loans.
One of the things I've seen in the last 10 years and been amazed about, and Alix and I talk about it a lot, is the growth of private credit. Is private credit coming into the real estate space to maybe just find some opportunity here?
Yeah, it has been for some time.
Okay.
2015 private credit market share of total lending was probably 10% plus or minus. And I'd probably say it's a little bit less than that. At the peak of the market, it was around 20% or so. But look, there is something to be said for private credit finding a home within commercial real estate. Look, there's 4,200 banks across the United States. Bank share is around 40% of total lending. There will be some banks that pull back for various different reasons. There has to be a home for those additional loans. And I do think private credit, if you have the expertise not to just underwrite the loans, but work out the loans when some of them inevitably go bad, there's a home. There's a home for private credit. Do I think it's going to 50% market share? No. I sort of think the upper limits is around 20%. We're probably a little bit less than that right now, but there's a home for private credit.
So when we talk about the shoe and office commercial real estate not dropping, it sounds like maybe it won't drop at all. It'll just be sort of, John Tucker's doing the wave, and I don't really know why that is, but
let me get the confetti out.
Oh, we hit it.
Of course, it just came back down.
Of course, it came back down. For a moment, it was down 40,000.
The tick up counts.
Yes, it does.
That was amazing. The shoe's not maybe going to drop. It's just going to be worked out, and then no one's going to be sitting with really terrible loans forever?
So this is going to take longer than what was feared a year ago. A year ago, when you had banks coming under stress, I think a lot of people were fearing a quick collapse in commercial real estate lending. That has not occurred. This will be a slow burn over a number of years. I want to be clear, though, we are not calling for no distress in the commercial real estate market. I mentioned to you that property valuations are down around 20% right now. We are expecting them to be down peak to trough around 25 to 30%. So around 2/3 of the way through. The next leg lower is going to be rising distress. And by the way, that actually might be a contrarian bullish sign. So what do I mean by that?
Setting the bottom, maybe.
Exactly.
Right.
Exactly. It basically means sellers are finally capitulating and selling where buyers want to buy. That's a healthy contrarian signal.
See, Rich Hill, I think half of the real estate finance people in the business came out of Morgan Stanley. It's like a mafia there, those guys. They're all over the place. Rich Hill is
awesome.
one of them.
That was fantastic.
Rich Hill, head of real estate strategy and research at Cohen Steers, joining us here in our Bloomberg Interactive Broker Studio, talking about the overall commercial real estate business, not just office and occupancy, but that's a one. But I can't wait to see what some of these buildings on 3rd Avenue, when they change hands, what the discount's going to be. I think it's going to be huge. Like the Lipstick Building, just to pick one. An iconic building, but it's not an A property.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in economics and finance all around the world with our great Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. What's not at a record is small caps. So they pushed higher yesterday. They were near a 2-year high, but not yet at a record. And today they're a little bit softer. So you have to wonder if that whole rally broadening out thing is still on the docket. Let's get more here with David Kudla, founder, CEO, and Chief Investment Strategist at Mainstay Capital Management. He's on Zoom from Naples, Florida. So that's not too shabby.
Nice.
Yeah, nice job on that one. David, 40,000 for the Dow. It's a nice round number. We like nice round numbers. You buying it?
Yeah, I'm buying it. Good morning, Alix and Paul. The market just has a lot of things going for it right now. There are things that were tailwinds or were headwinds have become tailwinds. We've got strong earnings. We've got a Fed that I think Jay Powell's looking for a reason to cut. And I think the Janet Yellen wants Jay Powell to cut so she can afford the service the debt, our national debt, better. And we look forward at market fundamentals. We look forward at what's happening with generative AI and what that means in terms of what we're calling the next industrial revolution. This deal with Apple and OpenAI and the power that people are going to have in the holding their hand in a handheld device. There's some things that can trip us up, but the market's really in good shape right now. And market sentiment has changed so much. Investor sentiment from just 2 weeks ago, it's incredible.
So, David, talk to us about earnings. What are your takeaways here for this earnings, which have generally been pretty solid across the board? What are your takeaways?
Well, we went through the earnings trough and we've emerged from that. And now when we look at first quarter earnings, we're coming in well ahead of expectations. Profit margins are the best in 2 years. And that's really the key. When there's so many questions about the Fed. Look, we've been, just since the beginning of the year, we've been all over the map on how many Fed rate cuts we'll get this year, anywhere between 0 and 7 or even a rate hike. But when we look over at fundamentals, just corporate earnings are coming in better than expected. And, that's obviously positive for stocks and one of the most important long-term factors. And we're looking for double-digit growth in earnings down the road this year. So it's a scenario that if we continue with some multiple expansion, earnings continue to do well. The Fed, if anything, that is looking to show that they're on a cutting cycle. They want to cut at least once to show they're on a cutting cycle. It's just they're having trouble. They got help with non-farm payrolls. They got help with retail sales, CPI. We're going to see an opening here, and that'll just be more, another catalyst, more horsepower for the bulls out there to take the market higher.
So does that mean
that is with it coming? I'm sorry, I was going to say with it coming on more in the spirit of a normalization of Fed policy, not because the recessionary forces out there are becoming overwhelming and we're seeing a slowing economy. We're not seeing that. GDP has remained quite strong.
So when you talk about the AI and the new industrial revolution, what's so interesting is that utilities over the last few weeks in May have been the second best performing sector in the S&P along with tech. Can utilities be a growth sector in this environment that you're outlining?
I think that's yet to be seen. The belief there, or the thesis there, is that there is going to be so much demand for all these super chips and all the energy required for this revolution, this implementation of generative AI. I think it's also investors looking for more areas they can diversify into, but I think it's yet to be seen how much that really translates. That demand for energy translates into actually pushing utility stocks higher. It's not a typical reaction function we've seen in the past, but we can see how it could be one going forward.
David, aside from the AI play, a lot of investors feel like maybe they've kind of, at least in the short term, missed some of the big seven, Magnificent Seven plays. What are some other areas that you think there's maybe value out there in the marketplace?
Yeah, well, we've been saying this for a while, even when we've had these sell-offs in the Magnificent Seven or the Fabulous Four, or really just mega cap tech.
Yep.
to stay with them, because they're really becoming all-weather stocks with these fortress balance sheets and wide moats around them, and their balance sheets. They companies like Apple. Microsoft doesn't matter what rates are doing. So it's such a good place to have a good portion of your portfolio in large caps, specifically large cap tech with that focus on AI. But yeah, we look to other areas that have done well, and it'll depend how the economy moves forward. There's still this risk we move into a stagflationary environment, which might lead us towards commodities. There's also, do we have a hard landing, soft landing, or no landing? We've been calling for the no landing scenario. I think we're somewhere between soft landing and no landing, but clearly in a Goldilocks economy. So a lot of different sectors are looking good.
Yeah.
And overseas, there are even some areas there that are attractive.
Well, where overseas? I know that the Nikkei in Japan has been a huge hotspot, particularly with the weaker yen.
Yeah, that's really our main play is Japan. A lot of it is in fact the currency play, and if you invest in Japan, do it with a currency hedged vehicle. But the rally in the Nikkei 225. I mean, we reached a high here that we haven't seen since 1989, when I was walking around the campus at Stanford learning how to invest and learning about business, right? I mean, it's been that long. And so there's, with corporate reforms, things that still are ringing true from Abenomics. Japan is in a position struggling with monetary policy, obviously, but with that weak currency, they're an exporting country. Their products are so competitive abroad. And so that's why they've done so well. You've just got to hedge that bet. Europe is starting to look a little bit better, too, from where they were a year ago. The concern here is where rates go, when you come to emerging markets and some of the other more interest rate sensitive economies, like, we've seen China, a resurgence in China recently, but we would continue to avoid there for now because of the structural problems they have. But it's really, right now for us, it's America first. The U.S. economy is still rolling, in a pretty strong manner. The consumer is still strong. We're wondering, how many times have we heard the consumer's running out of money? The consumer's they're gonna run out of pandemic money. They're running out of money. They're borrowing, but the consumer's still strong, and that's the mainstay of our economy. So no pun intended. That's the mainstay of our economy. And we're America first, with looking for some opportunities to tactically allocate to some other areas to manage portfolio risk.
All right, David. Always appreciate Checking in with you, David Kudla. He's a founder, and he's the Chief Executive Officer, and he's the Chief Investment Strategist over at Mainstay Capital Management, based in Michigan, but smartly right now in Naples, Florida, coming at us from Zoom. All right, the Naples days are kind of done. It's going to get like unbearably hot. Where you want to be from now on? Jersey Shore, baby.
Yeah, you kind of do. Also, like today, it's not that nice in New York. It's rainy and gross, but man, is it humid.
Yes.
So henceforth, the Jersey Shore, the Paul Sweeney house.
We're
all waiting for our invite. I mean, John Tucker and I were like,
I don't really need one. I'm down there too. I guess I have an invite.
Okay, I'm waiting for an invite to y'all's house. I guess that's not going to happen.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Deere is one of those names that reported earnings. And again, when I think about Deere, I think about it in the context of being a really good snapshot on where the U.S. farmer is in terms of their economic well-being. Chris Ciolino, he follows Deere. He follows all those industrial companies for Bloomberg Intelligence. He joins us here. Chris, what was your takeaway from Deere this quarter and the outlook?
You're right. It's all about the outlook. We expected them to cut their 2024 outlook. You saw that from their peers, CNH and AGCO. They both lowered their expectations this quarter. But the haircut this quarter for Deere was more than we had anticipated. They actually took net income down 8%. So we're looking at net income around $7 billion this year, which would imply earnings a little north of $25 a share, or roughly 8% below the street. And really, there's two things for the reduction in the outlook. One, farm fundamentals, farm economics continue to deteriorate, so we're seeing broadly weaker demand across the globe. And then two, they're going to have to underproduce retail demand here because inventories continue to pile up given the softer demand backdrop. So production will be down significantly in the back half of the year. But I think now the question becomes, is this cut going to be enough to destock the channel moving into 25?
Is it?
I don't think so, no, because I think we're going to see further degradation in the retail demand environment. The backdrop isn't particularly encouraging for farmers. I mean, we're still looking at lower crop prices. You have higher production expenses. Interest rates are still quite elevated. So net farm income is going to be down double digits for a second straight year. Wow. On top of that, you have broadly weaker farmer sentiment. They went out and bought a lot of equipment over the last 3 years, so there's really no impetus to go out and start spending again. And this is an election year, so add another layer of uncertainty on top of that. So we I guess, really struggle to see a catalyst, at least in the near term, that's going to really accelerate demand.
Well, is that good news for the John Tuckers of the world who want to go out and buy a John Deere tractor? Are they going to get a deal here? Are they going to get some competitive pricing?
You certainly can get a deal. We're starting to hear more and more about competitive pricing, particularly in South America, but there's too much inventory globally. We heard that from Deere on the call, at least particularly for North America. That seemed to be a change intra-quarter here where they're going to have to underproduce for the back half of the year. So both new and used, too much inventory. That being said, a lot of this equipment, even though it's sitting on lots, does come at a significantly higher price point than even just 5 years ago, given all the technological advancements.
So basically, this is still a cyclical business, and we haven't hit the bottom of the cycle yet. Do you have visibility on when we may do that?
It's a great question. No, I'm one in the camp that thinks that we're in a little bit more of a prolonged downturn. Historically, downturns in this business don't last 1 year. And if you look at, consensus expectations are for roughly flat sales and earnings for Deere and the ag equipment peers for next year. Historically, downturns last 2 to 4 years. We typically look at peak to trough declines north of 30%. We'll be down roughly 15% in terms of volume this year. Historically speaking, that tends to accelerate in year two. So it really ultimately comes down to, I think, what are crop prices going to do? I think that will be probably the early sign that maybe we're approaching a bottom, but we're looking at another bumper crop this year. Bearing some adverse weather, then I think you're going to see continued downward pressure there, though.
Chris, what are the crops that you look at and investors look at to see whether it's going to be a good year or a bad year for farmers? Is it soybeans, corn? What do you look at?
So there's three that matter. It's corn, it's soybeans, and wheat. If you think about it in the U.S., those three crops alone account for roughly 55% of farmer cash receipts or farmer crop cash receipts, which are essentially farmer revenue. So those are the ones that really move the needle, particularly for the large, high horsepower equipment, which really drive the earnings power for Deere.
This may be a really weird question, but the used tractor business, do Deere and Caterpillar, etc., do they own the resale, the second-hand business, or is it a different type of dealer that does that? And is there any sort of benefit to be made for them on that level?
So generally speaking, dealers are independent businesses. That being said, the OEMs do have pretty significant influence there. So they do make their own business decisions. But like I said, it's both a problem in the used market as well as that there's too much inventory out there, and until you could start maybe clearing some of that out on the second and third hand market, it's really tough to reaccelerate demand for new equipment, because most new equipment purchases typically will involve a trade-in of older equipment. And really the second and third buyers tend to be smaller, mid-sized type farmers. So unless there's some kind of improvement in farmer profitability, particularly for those farmers that are more pressured, it's really tough to accelerate that demand.
So soybeans, wheat, corn, when does that stuff get planted, harvested, all that kind of stuff?
Right now. We're right in the heart of planting season.
Okay.
I think about roughly 50% of the corn crop is in the ground. Particularly in North America, this is the planting season. South America, a little different. You get multiple growing seasons down there due to the climate. But really, we're squarely focused in on corn and soybeans right now. And really, if you look at soil moisture, it's actually quite favorable. So there's really expectations that this is going to be another bumper crop.
So you think you're going to get a bumper crop because the soil's moist?
We have moist soil now, so like I said, bearing some kind of drought, I think you probably see more downward pressure on crop prices, which kind of leads us to be probably a little bit more cautious heading into 2025, just because farmer incomes are still going to be under tremendous pressure, really what we think will be for at least a third straight year. And that's really just going to, temper buying expectations.
All right, Chris, we really appreciate it. Chris Ciolino joining us, Bloomberg Intelligence Senior U.S. Machinery Analyst. But it can't be too moist. You can't have floods and you can't have drought,
All right, John, your assignment today, go home and feel your soil. See how moist it is.
I don't think we need to do that.
You also run the danger of the seeds rotting before they sprout if it's too moist. So
exactly.
Too much moisture can be a problem
as well. That farming business is tough.
Oh my gosh.
At least with my begonias.
That's why you have crop insurance. You really need it because you're just, even though you might complain about all the handouts, etc., but it's huge.
It's big.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
If you remember, about a week ago, I attended the Boston Consulting Group Edge Expo in Boston, Massachusetts. Had the opportunity to chat with a lot of smart people, top execs at BCG. One was with Global Chair Rich Lesser. He engages with CEOs, boards of directors, and senior leaders around the world on critical topics, including climate change and artificial intelligence. I began the conversation by asking Rich what he spends the most time talking to clients about. Let's take a listen.
So it's been a remarkable decade, and it's not even half over yet.
Right.
And I think the two characteristics that we are living with right now to a very high degree is uncertainty and change. And they're not the same thing. Uncertainty causes you to want to hunker down, just get through it. Change forces you to be bold, to invest, to take some risk. And right now, more than I can remember, CEOs get pulled in both directions. How to navigate, particularly if you're like a European CEO, you've got two wars not so far away, and you've got all the pressures of energy costs and all the uncertainty of all these elections this year and so forth. You've got an enormous amount of uncertainty, but of course, just like CEOs everywhere in the world, you've got rapid technology evolution, you've got to prepare for climate change, all sorts of things. So I think that's the tension point, is how to balance those.
Let's talk about climate change a little bit here. It feels like maybe we're at a little bit of an ebb here in the U.S. I'm not sure I don't think that's necessarily the case in Europe, but I'm feeling a little bit here. How do you engage with your clients about climate change? What's the challenge these days? Is it convincing them that it's there, that it's an issue? Convincing them that they need to maybe invest in getting to a cleaner economy? What are some of the challenges you guys are seeing?
I think it's really important to separate what people want to talk about publicly and what they do. Many CEOs, particularly of leading U.S. companies, have made pretty substantial commitments over the last 2 to 3 years. But in making those commitments, they were very visible and public about it a couple years ago. And I think right now the sense is you don't walk away from your commitments. And I know very few CEOs, like very few, that I think are really trying to walk away from their commitments. I think most of them have tried to put them in their processes, ensure they get delivered. But at the same time, it's become such a politicized topic. We're all going to live on this planet. We're all going to bear the consequences of climate change. But unfortunately, in the public discourse, and in a very, it's an election year, it's just become very political. And I don't think CEOs want to be so public on these very difficult, divisive topics. So they're much quieter. They're not walking away from their previous commitments, but they're also being careful about new commitments, partly because of the public attention and partly because they don't know where the policy environment is going next year.
And I guess an example of that is ESG. It was the term for so many years, and now it's really fallen out of favor here in the U.S. in particular. But again, I guess the underlying commitment for many of those folks is still there.
Well, the problem is ESG, even people who were committed weren't always sure exactly what ESG was and what it meant. It was initials that were bundling 3 very different kinds of attributes together, and then it got politicized as a term without even people knowing why they shouldn't like it sometimes. So I think very few CEOs are using ESG language right now. You talk about your climate and sustainability commitments. You often talk about diversity and inclusion. Good governance, I don't think anybody questions, makes for stronger companies. But when you put it together in ways people don't understand, you're just almost looking for trouble. And I think CEOs, the last thing they want to do is look for trouble.
When you look at the economic data, which is what we at Bloomberg do all the time, and we talk about it all the time with a lot of smart people, what are you hearing about the economy from some of your CEO clients out there? It seems, again, there's some shifting winds out there for a lot of people, particularly those who own assets. Life's good. Those that don't, maybe not so much. That inflation thing, for example, is a real problem. What are you hearing?
So, look, we've been on the more optimistic side of the economic outlook for a while. Back when everybody was saying recession or super high inflation, we were of a position led by our chief economist, Philip Carlson, that we could get to a soft landing and that was not as low a probability scenario. Now we're living in a soft landing world, but one, soft landings for companies have hard edges. You still have wages growing faster than your power to raise prices. You still have low growth, not super high growth. It's hard to drive your own growth agenda without doing a lot of innovation. And so it's not so easy. And second, we're finding actually the glide path for the last 1,000 feet to the ground. We got a glide path from 30,000 feet of risk down to a couple thousand, but getting from a world of high 2s, low 3s down to well below 2.5, approaching 2, is proving to be tricky. And the consequence of that, as you say, is that interest rates are high, and there's much less sign of them coming down. And in that environment, it makes a couple things hard. First, for many consumers who don't have much in the way of savings, buying a car, buying a house, renovating a house, all of those things go up much more than the underlying prices do because of the interest costs. And second, for many of the capital investments we need to make, including climate and sustainability, things that look like they made a lot of economic sense a couple years ago are much harder to justify now. So if you have a lot of assets, you're right, it's not bad right now. You can get good value on. But if you've got to make investments, take on debt, do things, that is trickier.
We spent a lot of time at your conference here talking about AI and the investment needed in AI and the commitment needed and the ethics around AI. How prevalent is that in your discussions with your clients at the CEO level, the board level?
I am blown away by how much energy CEOs are putting into thinking this topic through. But for me, the big difference between the last 6 months and say the first 9 or 10 months since the big announcements, the last 6 months, people are less focused on thinking it through in the sense of understanding the technology and more about how they can drive business impact at scale. And for us, it's been honestly one of the most exciting periods I can remember on something where we went from less than 20 clients a year ago today working on this to 350. Wow. I mean, we've never had something like that. And I think that for us, there's a lot of opportunity that we're seeing now get materialized versus theorized. And CEOs are realizing it. They have to balance it. They have other priorities they have to do. They have to do it in a responsible way, to your point. Yep. Be careful there aren't hidden biases. Be careful they're not misusing the technology. But the underlying sense of opportunity right now has gone up quite a lot. And I think the more they see other companies delivering, actually putting it into results that they post, deeper customer relationships, the faster we'll see that come along.
Yeah, we met with, well, the good news for BCGs, you have a lot of smart people on this topic here. We've met them here today. One area was the ethics side. Your chief ethics officer was talking about that.
Steve.
Yeah, that's got to be front and center, I would think, for these discussions. Before you start thinking about putting dollars to work, you have to have a commitment, it seems like, to try to do this as responsibly as...
Yes, and it has to be owned by the CEO, not owned by the technology team.
Right.
This is a CEO level issue. What are the governance frameworks? What are the kind of biases to look out for? How do you have a process where you don't just put technology into the wild and hope you did a good job, but you're monitoring it in an ongoing basis, figuring out what the risks are, escalating the things to the right level, intervening in the right ways. That is a CEO and a top leadership agenda, and it's really important. But we are seeing companies navigate that really well. And so, yes, you have to be really careful, but that can't be the reason you don't choose to act.
Yep. All right. You've been in this consulting game a while here. How has it changed? You know, certainly before the pandemic, I'm guessing the business models for a lot of companies have changed here. How is your day-to-day, how's the consulting business evolved, over the last number of years?
So I'd say there are two massive changes over the last 5 to 10 years. Until 5 or 10 years ago, it was very clear. Get to the right answer for very difficult problems, make sure the change really happens. I think the focus right now on driving real, lasting impact goes up and up and up. We see it in so many client discussions. They don't just want partners to give them good ideas or give them a page of recommendations. They want impact partners that can team with to drive stuff through. And two, they need an enablement focus. They need a focus on building, because the world's going to keep changing. So making change once, however successful, is not sufficient. What you need to do is enable your organization, the people and the technology, to keep learning, to keep growing, to keep evolving. So the role of people like us are not just to make great change happen once successfully, but to build skills within the organization so the organization can keep growing and learning and evolving. And those two things have grown dramatically over the last 5 years.
All right, that was Global Chair Rich Lesser of BCG, Boston Consulting Group. I was up there attending their Boston Consulting Group Edge Expo in Boston, talking to a lot of their leaders, senior partners there at BCG about some of the issues they are working with their clients are on. A lot of it was about competition, global competition, technology, particularly AI as well. So a lot going on there, and they're getting more and more engaged with their clients.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.